Good Monday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man all the way from beautiful, sunny, cold Philadelphia. Dimitri Pogorelnik. How you doing, D?
Good morning, Will. How are you?
Great. Another nice win for your Eagles yesterday.
Oh, yeah. Did you watch the game?
I did.
That was a great game. I can't believe it's like their best record, I don't know, in decades. What are they now, like 11-1? So very exciting to be an Eagles fan in Philadelphia right now. But it was an exciting football weekend actually. But let's get started. Start with the disclaimer. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And with that, let me share my screen. Here we go. If you're joining us for the first time and you have a question, or anybody who has a question, put that question on the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on the show and ask your question live, we also provide a link to Zoom. Click on that link, takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, everybody could hear you. You could ask your question directly. While we're waiting for questions to queue up, we'll start with the pre-market report, see what's trading at pre-market hours. And then I'll move on, maybe continue on the discussion we had from last week regarding, one of the most important parts of trading is to be an efficient trader. And I really believe that's the difference between success and failure. I think a lot of people get into it thinking that it's about being right. So making the right calls, the market's going to go up, market's going to go down. And so much concentration is on that really what the missing part is that if you're not trading efficiently, if you're just either costing yourself too much or leaving money on the table or having the wrong setups, even when you have, a certain outlook, that could be the difference between success and failure. That's from my experience, from my training. And I'm going to try to start giving some examples as we go along. I showed one example last week where we looked at actual trades from the block trade screener and people who had positive outlooks, bought calls, stock went up, but they ended up still losing. And we can show the same thing for puts. So I'll show some more examples as we go along, but I think that that's the really important piece of the puzzle. So as we go along, you guys have questions, let me know, but I'm going to try to start showing some examples here and there, okay? Let's start out with the pre-market report. These are stocks trading in pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. And I'm coming down here and I see 103 stocks made our percentage gainers list, 41 on the decliners list. So from this perspective, it looks like we're setting up for a more bullish bias at the open. So let's filter down this list to only S&P 500 companies, see what's going on there. We're going to take out ETFs, leverage products, closed-end funds, preferreds, all that stuff. We're going to remove it just to see what's going on in S&P 500. And to do that, I'm going to use the filters here above. This one in ETF, when we drop it down, we have a list of ETFs to choose from. The SPY, that's the S&P 500 ETF. When you select that, the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. Here, we also see 15 stocks made our percentage gainers list, 4 in the decliners. So again, from this perspective, looks like a more bullish bias at the open. Couple of stocks that I see making the top of the list are casino stocks that look like they're rallying based on news that China is starting to reopen, right? So they're getting a boost, a bump there. But you could see 15 stocks right now made our percentage gainers list versus 4 in the decliners. So from that way, tilted more towards a bullish bias. Well, if you don't have any questions, I think I'll just move on from this report. You're mute.
Sorry about that. My dog was barking at someone delivering packages in the driveway. So I muted.
I know what that's like.
We did have a question from Lauren concerning crypto. He was asking, can Dimitri give his thoughts about trading crypto using Bitcoin or Ethereum futures, MBT and MET, or BTC, I guess was the other future option.
Yeah, I mean, we don't get too much into crypto, with the website doesn't concentrate on that part of the, investment sector. So as far as trading the crypto, I can't say I'm an expert. I know a little bit about it, but I can't say I'm an expert in the crypto space. So I'm probably not, I'm not even sure like what the question, it sounds a little bit general, but again, as far as trading cryptos and crypto exchanges and, staking and lending and I can't say, I'm an expert. I do have a friend who, we talk about it and he's done some code on the DeFi, some of these DeFi exchanges where you could, do lend out pairs or trade pairs. And, you got a lot of different exchanges doing stuff there. I'm not exactly sure how they're all interrelated. Like you could look at the FTX and you had a lot of people looking at that FTX exchange, a lot of investors who said they did their due diligence, and I'm sure they had access to books and records. You had other financial institutions that actually wrote APIs into the FTX exchange and did market making and did business on there, were integrated with it. And at the end, even they were caught by surprise of what happened on these exchanges. So as far as like the crypto space and trading and exchanges, it's not a very like regulated rules-based, system there like we do with the stock exchanges. And as far as like trading derivatives on the crypto and futures, and there's no one place to go where there's like, this is the clearing agency, these are the rules, this is how it is, because the FTX had a lending department, they had derivatives, and who knows, it all blew up on them. So it's dangerous.
Yeah, well, that's the
area right now.
Unlike, investing or trading in stocks and options on, regulated exchanges, you could have all the right positions on as far as, profiting from them and literally lose everything, right?
Yeah, there's counterparty risk. There's
exchange failure risk.
There's exchange failure risk. Yeah, like, there's bugs in the code. When we were looking at it, these smart contracts, there's code in them, right? The way that they're developed, a lot of times there's no intermediary. And I don't know, if somebody could hack into that code and what the risks are. It's a very difficult.
That's why I guess Laurent was asking, he says I meant taking a long position on Bitcoin using BTC instead of BITO. I'm assuming BTC is the future. I don't know what BITO is, but and then he goes on to mention futures and ETFs are regulated. I would say the only risk with the futures and the ETFs is how they're actually storing and holding and who they're trading with, right? That could be some. I would think if you want to get long Bitcoin, in my opinion, if you want to get long Bitcoin or Ethereum, I would try to learn the process of holding it in cold storage for yourself. That's my opinion, but whatever.
Yeah, exactly. And like, for example, Ethereum, you could hold it and stake it, right? So I'm not sure what the future, it's just a bet on the future price of it. But there are things you could do with the asset, that could yield you more, more of that asset, right? Because through staking or lending, I don't know with the future. I don't know enough about it, so I can't comment it, and we don't focus on that sector of the finance right now. So the answer is, I don't know. I don't feel
Good
comfortable.
answer.
Yeah, I don't know. Any other questions before?
No, that was it.
Okay. Let me walk you guys through some examples here. So this is actually a question I got over the weekend. And over the weekend, I get emails with questions. I thought this was a good one to bring up because it kind of dealt with the topic of being an efficient trader. And in the email, the customer brought up that he's seen a lot of these big notional option trades. And it was particularly in the puts. And I'll show you an example. So here's in Alibaba, and he showed me a bunch of them, but here's one in Alibaba. And as you could, so I'm on the Alibaba options chain. It was January 20th, 2023, I believe. I think I had it up there, but yeah, I think it was this expiration. And he's seeing a lot of deep in the money puts. So you could see here's Alibaba. It's $90, up a little bit today. But a lot of these deep in the money puts trade. All right. So here we go. Like here's 285 put to it would have to increase by 200% or whatever just to get up to the next 32 business days. So why is this happening, right? And there's a good reason for this, and the reason is when we talk about being efficient, and I gotta stress is that there, when I talk about inefficiencies, and we've been doing this for a long time, and as market makers, and there are inefficiencies all the time, not just by retail folks, which you do see a lot of, but by bigger firms, hedge funds. They're always kind of out there, and then there are other people who know how to exploit them when they see them. Okay, so people who know how to exploit them, they're not concerned about if Alibaba is going to go up or down. That's not what we're talking about here. Is there an inefficiency to exploit where there's money to be made? And another thing I want to show before I show you this example and explain to you what's going on here. Okay, why this is a very specific trade done to exploit somebody else's inefficiency. All right, this is not a directional trade. It has nothing to do with implied volatility. That's not what we're talking about here. Okay, these trades right here, you can see 800 puts. These are $200 puts, and I think he added up, I don't have it across, he added up, it was like millions of dollars worth of puts being traded. So this has nothing to do with trying to figure out if Alibaba is going up or down. Okay, that's not what we're talking about here. That's not what this trade is doing. It's not an implied volatility bet, but it is exploiting an inefficiency that somebody found in the marketplace. All right, let me open up the open interest over here, and I'm going to show you this because I'm going to show you that this inefficiency, you'll be able to tell it's not because someone bought a 1 lot or 2 lot, or it's a retail investor. This is somebody that's exploiting inefficiency, probably done because a hedge fund or big trading firm or whatever is not paying attention. And when we talk about, trading, and a lot of people also say, well, the more risk you take, the higher the reward. And that's not how I look at trading, and that's not how, I was trained, because you always look for the lowest risk first. Always look for the lowest hanging fruit. When you're out there searching for doing good trades, you're not searching where can I take the highest risk. You always look for where can I take the least amount of risk, right? The least amount of risk, almost where there's a potential reward, right? That's how, I was trained to look at it. So let's take a look at this trade really quickly. And why is this trade exploiting somebody else's inefficiency? Somebody's not paying attention. Somebody's doing something that's wrong. Somebody's trying to be right. Somebody's acting foolish here. And all these people here are going to go and exploit it and make a lot of money because of that. All right. So, and when I show you this, I got to also put a disclaimer that you as a retail trader will not be able to do this, to exploit it. Okay, because it does take a certain setup that you're not going to be able to do unless you have like this direct relationship with a clearing firm. So you're not going to be able to exploit it, but what you can do is avoid the inefficiency that somebody else exploits it, and that you leave money on the table. All right. So what's happening here is the following. We're looking at Alibaba, and when you understand options, right, when you really clearly understand options and how things work, and you're looking at it and you're saying, okay, here are the options chain in Alibaba, and I'm looking at the open interest here, and I'm seeing that there's a lot of these open interest left over, right, in these deep in the money puts. So here's a put 290, for example. All right, so the strike is 290, but the stock is $90. It's $200 away. 32 business days to go. So this put, essentially, whoever bought the put, right? Let's say the person who bought the put is short Alibaba by staying long the put. And at this point, that put moves 1-for-1 with the stock. If the stock goes down $1, right? Alibaba goes down $1, this put will go down $1. If the stock goes up $1, this put will go down $1. It's just moving. The put is moving 1-for-1. It's a one delta with the stock, right? So it's kind of like being short the stock, right? It's like it's the same thing as being short the stock 1-for-1. But what's the inefficiency here? So what's wrong with that, right? What is wrong with just then being long this put and being short the stock 1-for-1 instead of just being short the stock? Like, what is the real inefficiency here? And when you understand trading, when you understand options, part of trading always is cost of carry and interest. Like, that's really a big part of trading. Your cost of carry and the interest that you pay, the interest that you receive, the interest that you pay, the dividends that you receive, all this is a big part of finance, right? That's what finance revolves around. Borrowing, what you could borrow at, what you could lend at, right? Like a bank. Where can I borrow? Where can I lend? And so if you're short the stock, right? If you're short the stock at $90 in Alibaba, I'm going to try to do it without going through a formula or going through anything complicated. But think of it this way. If I short the stock right now in Alibaba at $90, I borrow stock from somebody, I short it at $90. What happens is that $90, right? After I sell it, $90 goes into my account. And if I have a good broker or whatever, that $90 should earn interest because that's cash in my account. So now that I have cash in my account, yeah, the stock could go up and down, same risk as the owning that deep in the money put. You know, if the stock goes up, my put will go down. The stock goes down, my put will go up. So it acts the same way, except now I have $90 in my account earning interest every day. So if you have, you know, what are the Fed funds, like close to 4%? So take out $90 times, you know, 4% annualized, you know, this 32 business days left. So you could see here that that starts to add up. It doesn't seem like a big deal to you, then that's fine. But what I'm telling you is that if you walked into a trading firm and said that, then they would never hire you, because that's where you would start anyway, right? And those things start to add up. So I'm going to show you really quickly what this means. Here's a person that has 240 puts at $200, right? So, I mean, I don't even know. I can't do the math right now in my head, but if I add all these up, all these puts, it's millions of dollars, right? So take millions of dollars right here. I think somebody told it was like $3 million. Take $3 million, you know, at 4%, it's hundreds of thousands, right? It starts to add up over a year's time. And this is happening not just in Alibaba and not just in this expiration, but in a lot of places. But just to give you an example here, let's say I own a put for $200, right? And let's do a simple example. If I own a put for $200, that means that I have an asset there that's worth $200, you know, in my trading account, but the trading account doesn't recognize it as cash. I can't earn interest on it, right? It's just $200 worth of an asset, but I can't earn interest on it. It's like owning a stock. But what if I did this? If I sold this for 200, and let's just say I'm convinced I want to own this put. I don't care. I don't want to be short the stock. I don't want to own that put, right? I just want to own the put. If I sell this for $200 and just come down here and buy this $200 put, which is still an early exercise. But what I did was, let's say I went down here, the 190. So I bought this for 100. I went down, sold this for 200, bought this put for 100. So I'm still short. So I have the same position on, right? Same pretty much same position. But what did I do? Well, if I sold something for 200, and then I bought something for 100, well, I have an extra $100 in cash now in the bank, right? I have $100 in cash earning interest, right? So what I just did was just have exactly the same position, just switch strikes, and now I'm earning interest on $100, right? So $100 times 100, you know, so you know, imagine how that adds up just on a one block, you know. And so what's happening here is the person here is probably a market maker or a hedge fund saying, well, I don't even care if Alibaba goes up and down because I could hedge this put. So they're knowing that there's an open interest. Two market makers are trading this between each other with agreement to exercise it. And once they do, what happens is that the person with the short, they end up with the short side of that position, right? And why do they want to be short? It's easy, because if you're short this put for 200, right? Well, what's your exposure? That you're long Alibaba 1-for-1. So then you go and short 100 shares of Alibaba, and you have a hedged position that's earning you daily interest. So you basically have a hedged position. You hedged off your directional risk, and you're just sitting collecting interest every day at 4%, or whatever your broker's paying, right? Assuming you get the risk-free rate, let's say at 3 3/4, or you go out and buy the treasuries with the money that you just brought in. But the point is that I'm making is I'm showing you certain things that are inefficiencies in the marketplace. And I'm showing you here where there's clear evidence that other people are even exploiting those inefficiencies, right? They're out there doing these trades. You'll see the open interest won't change. The open interest will not change from these guys doing these trades because they want that open interest to stay the same. But it's has not to do with trying to be right in the stock. They're just trying to look at the trade, look at the board, look at the information in front of them, do sometimes even like simple analysis, simple calculation, and say that there are inefficiencies all the time in the marketplaces that I aim to exploit because other people aren't paying attention. And what's happening is these are early exercise options that these people are forgetting to exercise. You could see here, some of them have, some sizable, pretty sizable open interest, in the thousands. But all right, we're coming up right up to the end. By the way, Thursday, no show. I just wanted to mention today, we'll mention it tomorrow. Thursday, no show. Will and I are going to a conference.
Well, it's the 1-year anniversary. We won the Benzinga FinTech Award.
So we're going to be there.
Best analytical platform. So we're going to give the award to the next winners, I guess. Who knows?
I guess, yeah. Yeah.
We will be in New York all day if any chameleons want to get together for a lunch date or something.
Yeah. So if we have time to leave the conference.
Yeah.
But we'll see.
Awesome job, Dima.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, chameleons.